Hello Sector Watchers, welcome to the show. This is the 124th episode of Sector Spotlight for Tuesday the 26th of April. I'm recording it on Monday the 25th. My name is Julius the Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. Well, exciting week last week. Lots of price action predominantly to the downside. Kind of what we've been talking about the last few weeks. So that is nice. But the next question is, where will it end? Will it end here? Will we see more? Have we had enough? And I will try to assess the situation of the current rotation for asset classes and sectors again in this show as we used to. Also, it's the last Tuesday of the month, which means that we'll have a look at seasonality, seasonal performance of sectors. See if we can find any sectors of which the current rotation is aligning with the historical performance. And if so, if that offers us opportunities that we can benefit from. Anyway, probably again a full show, so we're going to start right away. Ladies and gentlemen, this is Sector Spotlight. Kicking off with the rotation of asset classes. We have the weekly RRG on the left hand side and the daily on the right hand side. And we can see that commodities, DJP and GSG, are still very much in a relative uptrend, but they are going through a corrective phase. And that's very well visible on the weekly RRG, where you see both tails inside the leading quadrant, but they're losing relative momentum. They're still picking up a little bit in Norris ratio, but they're losing relative momentum. And you can see the long tails on the daily, but here also the tails for GSG and DJP are rolling over, and you can see that despite the fact that they are inside the leading quadrant and rolling over, they're already starting to lose, or they lost quite a bit of price performance last week, over 3%. So commodities still in a long-term turnaround, long-term relative uptrend versus VBINX, but currently going through a corrective phase. And because of these tails here on the daily already starting to roll over, that leads me to the belief that we need a little bit more corrective movement in both commodity indexes. I'm going to take those two off to magnify what we have on the plot here for, oh, where is that? Oh, V and Q, no, I want you to go, and then it fits, so here we go. So now we have the other asset classes, better visibility, and the two that stand out are the US dollar and V and Q, and also SPY, the stock market. If we switch to the daily view and we look at last week's performance, then we see that the dollar and V and Q, real estate, are in line with what's happening on the weekly RRG. So these uptrends, dollar strength and strength in real estate, are continuing. And if we look at, well, let's say stocks versus bonds. So here's stock SPY, and bonds are Gov, high yield, and corporate. And we've got the similar picture here on the weekly. Then last week was obviously not a very good week for stocks. It was in relative terms better for bonds, for Gov and high yield, although they still lost in terms of price. So this is a relative game. And last week, government bonds lost less than the S&P 500. Hence the rotation of stocks inside weakening towards lagging, and government bond high yield, and to a lesser degree corporate bonds in opposite direction. If you look at the longer term trend, then we see that SPY is actually rotating back into the leading quadrant, where there is a very clear downtrend for the whole fixed income complex. So high yield, GOV, and LQD clearly moving in a negative negative heading, negative RRG heading, which tells us that stocks are doing better, are in a relative uptrend versus these fixed income asset classes. Now we've all seen the performance of the stock market last week, and I think we can agree. Well, we can debate whether the market is in a downtrend or sideways, but I think that we can agree that the stock market is not in an uptrend at the moment. It's different for the bond markets. They are very clearly in a downtrend, and yields are in an uptrend. That's the opposite. And that downtrend in bonds is simply stronger than the downtrend in stocks, and that's why stocks are coming out on top, at least for the time being. So be aware of that. This is a relative comparison. In price terms, they're both not looking too well, and we're going to look at individual charts in a minute. I want to start with the price chart for the US dollar. Here is the dollar index. And I've actually had to lengthen my look back period a little bit. You will note that we now have a little bit more price history for the dollar index on this chart. And the reason I had to do this because this area wasn't on the chart previously. We're kind of taking out overhead resistance, and this 101 level, you can see, played a role in the past. Most recently was in 2020, where I am sort of inclined to ignore this spike here and take this cluster of highs around 101 as the most important resistance level. It looks as if we're breaking that right now. And then we had that same level playing a role back in 2015 in March and in November. On the upside, there after this, it looks there's quite a bit of upside left, and what we're looking at is probably 104. So that's the 2016 high and the spike high that was set in March. If we go to the euro dollar chart, we can see this is the daily, so this is a little bit more granular. We can see that the support around 108 is definitely being challenged, where we had some lows at 107.60. And on the upside, I think the resistance is now the 109.40 area. So for this dollar strength, euro weakness to continue, I'm watching euro dollar to break below, let's say 107.50. That'll be a very significant level to break. Now, if we go to stocks, to SPY, as we discussed a minute ago, on the weekly price chart, we can see that SPY bounced off that 420 level, that 420 area, which is clearly support. We had a dip to 410 in February, but the meat of the support, I believe, is around 420. That played a role here back in 2021 as well a few times. And there's 423 here in October 21. So that 420 level definitely attracts people, is a level of previous resistance, now support. The break of this previous high sort of put that definition of a downtrend, lower highs, lower lows, on hold. I think we're now more sideways. It's not really a downtrend on the weekly chart. Although we broke this trend channel, we broke the series of higher highs and higher lows, but we also ended the series of lower highs and lower lows. So we're now in a sideways movement. What's important is to keep an eye on the 460 area, so 456, 462, that's now definitely going to be a major area of resistance. And that 420 area for support. The market has to dictate what's going on. If we look at, and just by the way, for those of you who want to look at it from the positive side, you might want to look for positive divergence, just like we had negative divergence prior to the ending of the uptrend. There's none. There's no positive divergence to be found. As a matter of fact, this low here, the lowest low, was in the RSI lower than the previous low, so that's a confirmation of that downtrend. And the same is happening with the MACD. So there's no divergence spotted yet on the weekly chart. If we go to the daily chart for SPY, then we see a different picture. We see a couple of very weak days last week. This is Monday the 25th. We started off very weak and then we reversed during the day and we closed slightly higher. But if you look at the chart here, that's still pretty negative. And talking about trends here, lower highs, lower lows, definitely intact. If you're looking for resistance, this bounce could go to 435 without harming that downtrend on the daily chart. Here you see that 420 area, so the low today again was, what was it? It was 418.80, so that's very close to the 420 area. So once again, that area has been tested. We have to wait and see, but looking at this chart, I think that the upside is much more difficult than the downside. So I remain very, very cautious with the stock market. If we look at bonds, then you can see that IEF, the 10-year US Treasury bond, has reached its price target based on the massive head and shoulders reversal pattern that we labeled a couple of months ago. Big question is, how will it go now? I expect, because this is clearly a support level, that the bond market will stabilize here. Maybe go up a little bit. Maybe we got a little bit of a bounce. It wouldn't be weird if we got a little bit of a bounce after a, well, 114, almost a straight line with only a little hiccup here of 3 points. But after 113, it's a 10-point drop without a significant hiccup. That's a major move. That's a major move in bond market. And I wouldn't be surprised if we can see a little bit of a hiccup there. If we reverse that and we look at the yields, then you see that here also we're reaching that 3% price target. Again, a little bit of a corrective move here, and in the yield that would mean a little bit lower yields. Wouldn't surprise me. Now the big question, of course, is what's happening with the bar. So VBINX is the benchmark that we're using for this RRG for asset classes. So it's the center of the chart here. And if you look at that chart, so VBINX is a combination, 60% in stocks, 40% in bonds, and that's a combination of treasuries, high yield, and government bonds. Here, the downtrend is clearly intact. This isn't updated through to today, but last Friday on the close, VBINX breaking below its previous low. It's confirming that downtrend in terms of price. So that combination of bonds still clearly weakening with a chance of a little bit of a bounce, stocks in a sideways movement, and the combination of the two, the balanced index fund, clearly in a downtrend and breaking below its previous low on the weekly chart, continues to make me cautious with positions in both stocks and bonds. Before we start with the sector overview, I want to have a quick look at the seasonal patterns. And you know that usually I look at the sectors first and then we look at the seasonals, and we we try to match the two together. And so basically I then talk about sectors, I go to seasonality, and then I talk about sectors again. So I thought it would be smarter to look at the seasonal picture first and then talk about the sectors, and then include what we just saw on the seasonal picture. So here is the seasonal pattern for the month of May and June, July to a lesser extent. And there's a few sectors that stand out. Once again, it's communication services with 79%. And you may remember that it was 71% in the previous month. And I got back to that seasonal pattern a few times when we talked about communication services over the last few weeks. And we said it was a bit of a gamble because communication services was far to the left, inside lagging, but it started to creep up a little bit. It started to go through a bit of a recovery move. So my conclusion or my assessment at the time was that, hey, communication services is in a serious relative downtrend, but on the back of its strong seasonal pattern, we could see a good month for XLC in the month of April. And it kind of worked until week number 3. So when you look at the performance, the first 3 weeks of April, communications, so it wasn't great, but it was sort of in line, slightly higher than the S&P 500. And then about 2 weeks ago, we started to tank again, and XLC broke below support, and it completely lived up to the expectations of a downtrend and a relative downtrend. So that seasonal pattern was completely blown out of the water. And, you know, the 79% of May, the 57% of June, and the 64% of July, with the current position of XLC on the RRG, we'll look at that in a minute, I don't think it's going to happen. The same with technology. Technology's 70% of the time has been outperforming the S&P 500 in May over the last 20 years. If you look at the position of XLK on the RRG, if you look at the price chart in combination with relative strength, I think that's going to be a long shot. So the seasonal pattern looks good, the current rotation doesn't look good, so it's not a great match. But there's one sector where we do have a match, and that's financials. Seasonals expect 30% of outperformance. That means a 70% of underperformance. The odds are pointing to 70% chance of underperformance for the financial sector in the month of May. And the same goes for June, and then in July it's only 45%. So the seasonal pattern for financials in the coming months is actually pretty weak. And if you look at the tail of financials on the RRG, especially on the weekly, then we are at a negative RRG heading and at a serious period of relative weakness for the financial sector versus the S&P 500. So that's a combination that I think is worth our attention. If we look at the expected performance numbers, then here's XLC is expected to be 1.2, 0.2. Again, it's not that there's no match between current and seasonal. Same goes for technology. But look at financials, 0.5% and 90 bips average underperformance in May and June for XLF. So that's something that I definitely want to put on your radar for opportunities, for potential opportunities. So what about sectors? Look at the daily RRG on the right, weekly on the left. And we can see that last week was, how do I describe that? A sort of a rotation midweek. You can see that a lot of these tails are bending over after a few days. So they're updated through to today. So this is today, and then we got, this is Tuesday, so it's five trading days. And you can see so that Friday, Thursday, Wednesday, that's sort of the midweek reversal, change of rotations that took place. It's happening in discretionary, from a positive point of view, technology from a positive point of view, healthcare from a negative point of view, so basically staples, utilities, so the defense from a negative point of view, and we saw industrials moving quite strongly, we saw financials moving quite strongly until basically today, and we see communication services confirming its downtrend. If we put that in a longer term perspective, then again, the energy sector is way to the right. We all know that. We also know that it's going through a corrective move. Here on the weekly, clearly visible, and the little hiccup that we had, the positive period is rolling over on the daily. So basically just like the rotations for commodities, which are super strong on the weekly, they're losing relative momentum. I think it's the same story for the energy sector in the equity space. So again, I'm going to tick that off here and magnify the chart for the other sectors. And then we can see that the defensive sectors are still in play. We got staples, which is hooking back up. We got utilities, which is way in the top right. We've got healthcare that is very stable, moving higher. So that picture didn't really change. We got technology moving further to the left. We got discretionary doing, how do I say that, relatively well, despite the fact that it's in a clear relative downtrend, it's in a lagging quadrant. But it's sort of vertical move on the JDKR's momentum scale, which gives us some room to breathe, but it's definitely not one of my favorite sectors yet, because things can change. And we see that communication services, despite the pickup here, still a very weak sector. It's, if you measure on the JDKRS ratio scale, it's still the weakest sector around. If we go through a few, let me first go, before I'm running out of time, the big move on seasonality. We just saw the seasonality charts, and the one sector where we have an alignment of the current rotation and the expectation based on the seasonals is financials. And if we highlight the sector here, then you can see a very clear weak rotation, which is now crossing over into the lagging quadrant. And if we bring that up on the daily, then we have financials inside the improving quadrant. But as you can see here, it's starting to lose momentum as of today. Now, if I bring that to a price chart, then I think that you can clearly see what the problem is. So weekly chart, you see lower highs, lower lows until, well, this is today. So today, financials dipped to a low just above 35, which is about the support level that we've seen a few times in the past. We are now barely holding up in terms of relative strength in this range, and we've got both RRG lines pointing lower. So what we need for this to materialize is a break of relative strength below the lows of this year. And the catalyst for that can very well be a break below 35 in price for XLF, the financial sector. So when that happens, when XLF breaks 35, it will very likely break support in relative strength, point the RRG lines even lower, and push the XLF tail into the lagging quadrant, making XLF an underperforming for the month of April, as it is suggested by the seasonal pattern. So there you go. That's the make it the call, make it the assumption, make it the alignment, the one sector where seasonals and current rotation are aligning. If we quickly look at a few of the other sectors, energy, as you can see, still way above its former resistance level. There's plenty of room to maneuver for this sector without harming the current uptrend. I think about 70 is an intermediate support level, and then you could even go to 65 without doing too much damage. If you look at utilities, kind of similar. We broke out above 70, 71. We're dropping back now. As long as we remain above these previous highs, they're now expected to act as support. Things continue to look good for utilities. Healthcare, it dropped back below its previous high, so in terms of price, it's in a sideways move, but relative strength-wise, we're still holding up above former resistance, which is expected to continue as support, and the RRG lines continue to move higher. So the defensive sectors are still leading the S&P 500. They are outperforming the S&P 500. Consumer discretionary in its range, it's holding up in terms of relative strength. That's the hiccup, that's the move, the vertical move in RS momentum. Be careful when that starts to roll over and you see weakness in the green RS momentum line, that's the moment where you got to start being very, very cautious again. Technology is resting above 140. I think that's an important level. There's a lot of earnings being announced this week for a lot of tech companies, a lot of major tech companies. I've looked at the individual charts for the technology sector. In general, I don't think they look very good. If 140 breaks in XLK, I believe there will be much more downside price action in technology, and it's going to push the technology sector further down. And then finally, we have communication services. Again, we just broke last week before the previous low. It's completely confirming the weak relative position, the weak stance for the communication services sector at the moment. And that wraps up Sector Spotlight for this week. Thank you for watching. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. If you want to reach me, use any of the handles on the screen. And I hope to see you again at a new episode of Sector Spotlight next week, same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.